You have it all wrong. Stop paying attention to the Fed cutting rates or not cutting rates. This is a quick reminder that if you're watching the Fed headlines for mortgage rate forecasts, you're doing it completely wrong. Do you ever feel like mortgage rates are gaslighting you? Like they know exactly what you're hoping for and then they do the complete opposite? Well, brace yourself. Because what you thought you knew about mortgage rates is probably entirely wrong. And it's costing buyers, sellers, and even real estate pros who've been in the industry for decades thousands and sometimes tens of thousands of dollars. Let me help you visualize something. It's a young couple. It's 2025. It's a young couple. They're hopeful. They're anxious. They're glued to their phones, refreshing the news every time the Fed speaks. The Federal Reserve is about to announce an interest rate cut. Rumors are swirling. Financial commentators are buzzing. The couple breathes a sigh of relief as the Fed finally announces a rate cut. That's it. This is their moment, they think. Mortgage rates are going down, they think. The moment they've been waiting for is here, they think. But then nothing. 1 week later, their mortgage quote, exact same. 2 weeks later, still no change. In fact, their mortgage rate actually went up. This disconnect is one of the most misunderstood and costly concepts in real estate because here's the truth most consumers and even most professionals miss. The Federal Reserve does not control mortgage rates, not directly, not in the way that you think. Mortgage rates are not set by the Fed's overnight lending rate. They're set by the global bond market, specifically what investors are willing to pay for mortgage-backed securities or MBS. Here's what's actually happening. When the Fed changes its federal funds rate, it's adjusting the very short-term benchmark. Basically, the rate at which banks lend to each other overnight. That's a lever that moves things like credit card interest, home equity lines. But mortgage rates, especially the 30-year fixed ones, are long-term loans. They respond not to the Fed's hand on a wheel, but to what investors think about long-term risks like inflation, economic growth, and what kind of return they will accept to lend money out for decades to come. That's why mortgage rates tend to move in tandem with the 10-year Treasury, not because they're pegged to it, but because treasuries are the benchmark for all kinds of debt. Mortgage bonds need to offer a premium over treasuries to attract investors. That premium is what's called a spread. And that spread has been doing strange and scary things over the last couple years. Historically, the spread between the 10-year Treasury and 30-year fixed mortgage hovers around 1.6 to 1.8 percentage points. The relationship is the norm in stable markets, but in late 2022 and 2023, that spread blew out to nearly 3%. That's a level we haven't seen since 2008 financial crisis. It means that even when the 10-year Treasury looks relatively calm, mortgage rates are elevated because investors are demanding a bigger buffer for uncertainty, volatility, and risk. Why is the spread so wide? One major reason, prepayment risk. Think about it from an investor's standpoint. You buy a mortgage bond expecting 30 years of interest payments. But if interest rates fall, borrowers refinance. Suddenly, you get your principal back early and have to reinvest at lower returns. That's bad for you. So in times when rates are high and people are expecting they'll fall, that prepayment risk skyrockets. Investors know they might get burned, so they demand more compensation up front. And that shows up as higher mortgage interest rates. Now, add in the Fed's retreat. During the pandemic, the Federal Reserve was the biggest buyer of MBSs on the planet. They were supporting the market, keeping yields artificially low. That's part of why we saw mortgage rates dip below 3% in 2020. But in 2022, the Fed reversed course. They started shrinking their balance sheet, letting bonds roll off and not buying anymore. That's called quantitative tightening. And it's a game changer. It means one of the biggest, most reliable buyers of mortgage bonds has absolutely left the room. So private investors now have to absorb all that supply, and they want better returns for doing so. That drives mortgage yields up, but there's more. The U.S. Treasury is issuing massive amounts of new debt to finance growing federal deficits. That's a fire hose of supply flooding the bond market, and all those treasuries compete with mortgage bonds for investor dollars. If treasury yields rise to entice buyers, mortgage-backed yields have to rise too. Otherwise, investors will just stick with a safer government debt. This crowding out effect has put enormous upward pressure on mortgage interest rates. We also have to talk about labor markets. So far in 2025, unemployment has remained low. Wage growth has been steady, and for the Fed, that's a reason to be cautious. A strong labor market makes inflation stickier and reduces the urgency to cut rates. And as long as the Fed holds its ground, investors assume rates will stay elevated. That keeps long-term bond yields and mortgage rates stubbornly high. And yet, despite all of this, there are glimmers of hope. Inflation has come down from 9%. It's hard to believe. 9% in 2022 to closer to 3% mid-2025. Some monthly readings are even showing 2.3 or 2.4%. That's getting very close to the Fed's target of 2%. And in response, we've seen the 10-year Treasury yield soften a bit. But mortgage rates haven't fallen nearly as quickly. Why? Because that spread, that stubborn gap between Treasury yields and mortgage rates, it's still elevated. And this is where spread normalization becomes critical. If nothing else changes, if the 10-year Treasury holds at 4%, but the spread comes down from 2.5% to its historic average of 1.7%, mortgage rates could drop from 6.8 to around 5.7%, purely from the market just calming down. That's massive. That's affordability. That's the difference between someone qualifying for a $400,000 home and a $460,000 home. What could bring the calm? Several things. One is sustained incredible return to low inflation. We've talked about that. If markets believe inflation is under control for the long term, the fear premium built into the yield will shrink. This is where tariffs have played a role. There is uncertainty on how tariffs may spark inflation. Another, recession. Not a market crash, but a standard economic slowdown. Recessions trigger a flight to safety. Investors flood into the bond market. Yields drop. Mortgage rates follow. That's what many economists, including Mark Zandi, are projecting. A mild downturn by late 2025, which could bring rates into the low fives or even the high fours, but there's absolutely no guarantee about that. There's also the labor market softness. The Fed has made it clear they're watching jobs. If unemployment rises meaningfully, that gives them the green light to pivot. And when the Fed pivots, not just a 0.25% cut, but a real policy shift, investors will react. Long-term yields will come down as bond buyers anticipate further easing. And mortgage rates will come with them. Another underrated piece of the puzzle is the MBS investor base. Right now, demand is still cautious, but MBS yields at 6 to 7% are starting to look pretty attractive. If volatility fades and if inflation continues to cool, investors will start buying in again. Pension funds, insurance companies, foreign governments, they're always hunting for yield. Once they feel confident their buying will push MBS prices up, yields down, and mortgage rates lower. And let's not forget about the yield curve. In 2023 and even in 2024, we saw some unusual inversions. Short-term treasuries were higher than long-term ones. That distorted normal bond pricing. In some cases, 7-year yields exceeded 10-year yields. And since most mortgages don't last 30 years, the average life is 7 to 10 years, those shorter maturities matter. Now, as the curve begins to normalize, that distortion should fade. That means fewer pricing quirks and better alignment between expected loan duration and bond investor assumptions. So, where does that leave us? With opportunity and warning. If you're a buyer, waiting for the perfect condition is dangerous. When rates finally fall, pent-up demand will absolutely explode. You'll see more competitions, prices climbing, inventory tighten, and the deals you had in front of you will absolutely disappear. But if you're prepared, if you understand how the mortgage market really works, you can move before the crowd. You can work with a lender who understands spread dynamics. You can structure your loan knowing that refinancing might be in the future, although not guaranteed. And you can buy when others are still hesitating, and that's key. This is more than just a story about interest rate. This is a playbook for how wealth is built. It's built in margins, in the quiet, in the moments where complexity scares most people away. But you're not most people. You're here, you're listening, you're learning. So keep watching inflation, keep tracking the 10-year Treasury, pay attention to the MBS spreads, Fed speeches, labor market data. Understand that mortgage rates are not set by a switch. They are a reaction, a reflection, and the deeper your understanding, the better your timing will be. Because the people who win in real estate aren't the ones who wait on the headlines and tell them what to do. They're the ones who know where to look and move before anyone else does. The storm will not last forever. The volatility will ease. The spreads will normalize. And when they do, the window will be wide open. Be ready. Knowledge isn't just power in the game, it's profit. And that is 100% mother effing guaranteed.